Hello, everyone, and welcome to our new webinar on calculating investment returns. I'm Warda Mir from One Investment. Today's session will cover two commonly used methods to calculate investment returns, which is time-weighted return and dollar, or also known as money-weighted return. I'm pleased to be joined by James Giles, our guest speaker for today's session. James retired as Chief Investment Officer from Foresters Financial and has over 25 years of financial sector experience. He has lectured for many years as part of various preparatory programs, including Chartered Financial Analyst designation. James sits on our Investment Advisory Committee and also a member of One's Joint Investment Board. So let us get started with the presentation. Handing over to you, James.
Great. Thank you very much, Warda. So there are two primary methods that people can use to evaluate investment performance. One is a time-weighted method, and the other one is a dollar or money-weighted method. Dollar, of course, is particular to North American countries, but it could be a euro-weighted method if you're over there. So what is the difference between the two methods, and why might you pick one over the other? With the time-weighted method, you're looking at investment returns based on a dollar or a set amount of money. It is not recalculated, or it's not sensitive to additions or subtractions to the account, contributions or withdrawals, whereas the dollar or money-weighted method takes that into account. In simple terms, the time-weighted method treats a return for a period of time, and you then link that with other periods of time when you have put in or taken out money. But if you have 10 times the amount of money in the second period, you don't weight that return by 10 times the size. In the money or dollar weighted method, you do. Why do you have two methods? And why would an investment manager choose one or the other or prefer one? The time weighted method takes out the contributions and withdrawals from the calculations effectively. Therefore, the money manager would prefer that method because it reflects their skill. They do not control the timing of withdrawals and contributions from the account. The client does. Now, for the client's point of view, they're interested in what their actual return is. So therefore, the dollar weighted return in some circumstances might make some sense for them. However, there are drawbacks for the client using the dollar weighted method in terms of the comparability of performance between their fund, another fund, a benchmark index, et cetera. And we'll discuss that later. So I try to use a simple example here to illustrate the difference between the two methods. So initial investment of $1,000, the return of the first year is positive 25%. And return in the second year is negative 20%. If you do the calculation, which you see below, you see that year one, your $1,000 grows to $1,250. And at year two, the $1,250, having lost 20% in the second year, goes back to $1,000. So that will result in a time-weighted return of 0 over the two periods. You start with 1,000 and you have 1,000 at the end of year two. Now, to illustrate the difference with a time-weighted method versus a dollar-weighted method, let's say that we have the same example, except at the beginning of year two, the client adds another $2,000 to the account. The time-weighted method will still, because it only uses the returns for the period, 25% positive in year one and 20% negative in year two, the time-weighted return will still be 0. In other words, even though the year two had more money invested by the client, it does not factor into the return on a time-weighted method basis. On a dollar-weighted return, though, as you can see in the example, again, at year one, you start with 1,000, you make 25%, you have 1,250 at the end of the first year. At the end of the second year, however, because you've added $2,000, you've lost 20% not only on the 1,250 you had at the end of year one, but on the 2,000 you put into the account during year two. So your year two balance is $2,600. Now, how much was the total invested by the client in that case? 1,000 at the beginning of the period, and at year two, another 2,000. So the total investment was $3,000. At the end of year two, the balance is only 2,600. So if you would do an internal rate of return or dollar weighted return calculation, you would find that the return over the 2 years and at an annual rate is just over negative 10%. So you can see the contrast. Time weighted return 0, dollar rate of return negative 10%. So the difference between the two methods is the time weighted return did not weight the second period where there was a loss in the account any more than it weighted the first period when there was a gain in the account. It treated them as equal weights in the formula. Whereas in the dollar or money weighted return, because you had more money invested in the second period, it placed a greater weight on that. And as that was the money losing period between the two, you had a negative rate of return under the dollar weighted method for the 2 years. So does one method, the time weighted method, always exceed the other, the dollar weighted method? No, it just depends on what happens during the periods where you invest or take away money. So in the example I gave you, the dollar weighted method had a lower rate of return because you had more money invested as a client in the period where you had negative returns in the portfolio. If I changed the example and had a big upward movement in the returns in the second period, the dollar weighted return would have been higher because you would have had more money invested in a period where the returns were greater. Now, an important thing that you do as an investor, and we review at a board level, would be manager evaluations. So what is a good basis to compare how your manager is doing? Typically, what you do is you look for a benchmark or some way of looking at a manager's performance versus a readily acceptable and available alternative. An example would be for a US manager, and if they're investing in large company stocks, the Standard & Poor's 500 or S&P 500 index is a benchmark. You can invest in the S&P 500 index fund, and therefore it's an investable index. And that invests in the same types of companies in which that manager would invest. So therefore, you could compare your performance, your manager's performance versus that benchmark and give you an idea whether your manager is doing well or not so well. The benchmark does not recalculate or does not dollar weight its returns, it time weights its returns. So therefore, if you choose a time weighted return method of calculation, you're comparing apples to apples. If you try to use a dollar weighted benchmark, or sorry, dollar weighted performance versus a time weighted benchmark, it makes it very difficult to compare. Another method that some people use to look at manager performance is to group similar managers into a group. And again, if you start using dollar weighted performance, because client inflows are not going to be the same in and outflows to the account, it will make it very difficult to compare manager performance versus a group of similar managers. So if everybody uses time weighted methods, it makes the comparison much more easy. Just a little quirky thing with the calculations, which sometimes confuses people. There are what are called a geometric versus an arithmetic calculation. So in the example I've given you, if you have $1,000 to start with, and you make 10% in the first year and 10% in the second year, and you've left the money in, what do you end up with? Well, you have 1,100 at the end of the first period, and then you have 1,000 plus 100 plus 110, or 1,210 at the end of the second period. If you do an arithmetic calculation, you would show that you made $210 out of a starting investment of 1,000 over 2 years. Arithmetically, that would be 10.5% per year. But geometrically, which is the more accurate way of looking at it, if you leave your money in the account, you would have made 10% per year. And for anybody familiar with calculating internal rates of return, you can use that methodology and get a good dollar weighted approximation. So if you're looking for a method which is going to be generally used by the industry and by consultants or by one or whoever else you're going to deal with, the time weighted method is the one that's generally used in the industry. And that again is because it eliminates the inflows and outflows over which the manager has no control. And you can compare it to benchmarks, which again don't have those inflows and outflows to consider. So it's a much better way of comparing across the industry or with benchmarks. And it is compliant with industry reporting standards. There are general standards for the industry, for the investment industry, and the time-weighted method complies with that.
Thank you, James, for sharing those tools and techniques with us. It was very informative. So I've put together a couple of commonly asked questions by our investors, and we would like to hear your thoughts on those. First one is, in your opinion, for a treasurer, what is an appropriate method to evaluate the portfolio manager's performance?
So the most appropriate method from my point of view would be the time-weighted method, because what you don't want are the treasurer's decisions on contributions and withdrawals affecting the returns calculation as it would with a dollar method. Again, the investment manager has no control over when a treasurer would choose to withdraw or contribute money. So if you're looking to evaluate the skill of the investment manager and wondering whether they're doing a good job, the time-weighted method makes sense. And again, any industry benchmark that you would use would be time-weighted as well. So you're comparing apples to apples there. Similarly, if you're looking at other investment managers in the same general area in which you're currently invested, that you'll see time-weighted numbers for them. So for consistency and comparability basis, the time-weighted method is good.
So should our investors use these returns that you've mentioned exclusively to determine whether or not their portfolio manager is doing their job effectively?
That's an excellent question, Warda. The returns, if you look at returns on an absolute basis, in other words, if my manager's returns were -3, did they do a poor job? And that's not necessarily the case. You have to look at what applicable benchmarks we're doing for them. So in Canada, we use the S&P TSX Composite Index, and if for large cap stocks, if the return for that index was -5% for the year and your manager was -3, your manager was actually doing a pretty good job. So you wouldn't necessarily be upset with them because of the negative number. What did their fellow managers do? What did a relative benchmark do? The other thing to keep in mind is they were hired to do a particular thing for you, like in this case, maybe buy large cap, large company stocks. If they're following what they said they were going to do, and there is nothing else with the firm that gives you cause for concern, like personnel changes or whatever, then you should be okay with what the performance. And the basis for that is over long periods of time, equity returns have been strongly positive in the high single digits on an annual basis. So in that period of time, you will have negative years. In the JP Morgan Guide to the Markets, if you look up the S&P 500, which is their large stock index in the US, they've had about 7 years that were negative out of the last 40 odd. So that will happen over periods of time. The important thing is to understand what the markets are doing, understand how your managers have been doing what you've hired them to do. And if they're being consistent with that, then as investing is usually thought of as a long-term exercise, you need to then have some patience with that.
So that leads to my next question, and this is a common one. A client would call and ask, our investments have negative returns. What do I do about it? What tip would you like to give those who are in a similar situation?
The important thing here is, what is your philosophy? Why are you in the markets? Is what the manager has been hired for, is that what they are actually doing? and if they are following through with what you hired them to do, and in the belief that markets will provide positive returns over long periods of time, which has been the history, then you don't want to worry about short periods of negative performance. If you start trying to time the market, the history for that hasn't been very good. If you believe some of the studies, like the Delbar study that was done, that shows that people, now of course this is retail, but nevertheless it's relevant, that people underperformed relevant benchmarks that were used because they're trying to get in and out of the markets. It's extremely tough to do and can be extremely painful if you get it wrong. So if you've set a plan and you can withstand the losses, then you should just stay your course. Don't change your course readily and frequently. You're quite often doing it at a time that is bad to do it. You're letting your emotions dictate your common sense or overrule your common sense. So when these times come up, speak to your advisor. And for example, you can speak to One Investment if you're a client of One Investment, and they can help you sort of stay calm, stay on course, and understand that there will be bumps in the road over long periods of time with investments. But if it's a long-term exercise, you should, historically speaking, do all right.
Okay, thank you, James. That concludes the questions we had for today. Thank you so much for joining us. For those who are watching, if you have any further questions, something that has been missed, or you want to know more about, please email us at one@oneinvestment.ca. You can also give us a call. There is a number provided below on the screen. Thank you so much for watching.